Hi, welcome. My name is Jonas Thulin. I'm head of asset management here at Erik Penser Bank, and I will try to show you the tip of an iceberg of our weekly analysis and where we are, what we think of the world and equities, which is obviously a main focus for us right now. We have taken the view to keep our overweight position in equities and commodities. The reason is that we have turned everything into pretty much dollar positions. We have 100% open currency exposure. We are also long VIX and we're short S&P 500. We try to isolate the alpha of our portfolio. Our portfolio are all these trades, and the thick blue is the world benchmark, global benchmark, and our idea here is to isolate the alpha that we can get from these positions. So far, we are delivering more than or losing less than the global equity benchmark, but obviously we strive to have a positive impact. So why on earth are we then overweight, given the fact that the equities are selling off? Well, because with the global mandate, global bonds have sold off more than our global equity portfolio. That means that from a strategic asset allocation point of view, which we show here, it would have cost us more to be neutral weight equities and try to push up bonds. The gray bracket here is pretty much how much our strategic asset allocation is delivering on top of our tactical asset allocation. And we can see that despite being so heavily invested in equities, we're actually increasing our gap to a neutral weighted portfolio in the core. But this is obviously depending on our capability of being with open currency overlays, VIX, short positions, etc., which we are in our discretionary portfolios. Another topic that we raised a couple of weeks now is peak inflation in March. This is break-evens. Top right, you see credit card, how much we spend on gas stations in the US. Bottom right is a key graph for us right now. There's a lot of talk on Chinese ports and the data and the queuing and everything. This is Chinese supply chain pressure index versus the export price, i.e. how much inflation does China export. Our view is that yes, there's been a push, a negative push in supply pressures in supply chains in the Chinese economy, but they're actually falling away a bit. Historically, this has a tendency to just collapse. As the economy reopens, which we track by following every day the traffic on Chinese subway stations or subway trains, we can actually start to see this start to peak and roll off, which is quite interesting. So we're keeping our view that CPI peaked in March. Obviously, that relates to the fact that Fed fund futures are pricing in less of a hike. This is where we were on the Fed hiking day. This is where we are today. We shaved off 50 basis points. This is in terms of how many hikes do we actually see in the economy. This is where we put our necks out on the Fed day and say too much is priced in. We stick to that point of view. With our hedges, we can afford, so to speak, still being overweight equities on those selected strategies that actually can compete with the global benchmark. When we look at the equity market, we think that margin debt has been sort of the chief culprit here. Now we can dress this animal in different sizes and shapes. We could translate it into a financial conditions point of view. Obviously, they're all related. Once the liquidity and rates move too high too fast, which we show on another slide, margin debt has to be taken off the shelves, shaved away. It increases the selling pressure, and we can actually see now margin debt, which was kind of high, is now actually coming interesting, potentially a trough. I don't know. We tried to model a trough here, and it looks like the signs are increasing to start to build up margin debt as yields are coming lower. This is an interesting development for us to follow. Not enough yet to sort of chunk out our hedges, but it could be a potential theme going into the summer. In terms of the equity market, not all signs are negative anymore, which we think is quite interesting. On this one, we're actually following a Bloomberg article where they tried to pinpoint the usual suspects for looking for troughs and peaks, highs, lows, advanced declines, bullish, bearish, and the vol curve. The upward move right now seen in the time series is extraordinarily strong. We've seen this before, 2020, 2016, 2015, right on the troughs of the equity market. Again, an interesting signal that we follow. We keep our hedges, but also our overweight. So we don't just sort of speak go all in on this, but it's interesting to note that not everything is pitch black out there, far from it. The underlying message from us is that the equity market will fall back on the macroeconomic backdrop and earnings. In our chart pack you can actually see where the EPSs are, and also keep in mind the EPS were revised upwards in the last quarterly earnings reports that we saw right now starting to finalize for the S&P 500. Also that the macro momentum in the US is quite strong. This is about 4,000 time series in these two graphs, and they're not indicating a collapsing economy, far from it, which sort of makes this whole equity sell-off quite interesting. Now I would try to put it into context of economic theorem just to see how extraordinarily rare it is without having a sharply slowing earnings or macro momentum, anything like that. It could just be, i.e. high rates, we can't afford the margins or the leverage positions, we have to shave them off. Then it pushes CTAs to start selling. And that could be actually the name of the game, but we're not quite there to put our foot down on it being a fact, but the data starts to stack up like that. And we're going to stick to this growth story. The recession probability is actually falling as we're speaking. This usually has about 2-year lead time into equity at slowdowns and equity sell-offs, which we think is quite interesting. The Fed's own recession model as 14.5%. We can't see recession risk for next year, which is positive, obviously. But obviously there are risks that we monitor, but we can all talk about risks. It's not a thing to actually trade on them. So we're going to stick to the portfolio we have, albeit that we do actually have hedges on our equity portfolio for the time being, because we can't be naive on the price move. It is what it is, basically. And on growth, we think one thing that we cannot miss is that we can actually see sharply increasing rate of growth. We've been arguing for a reacceleration for a couple of months now in the US. And this is quite interesting that we now have nowcasting models from New York Fed that shows that GDP momentum has moved from a 2 to a 4.5, 475-ish percentage points. Obviously that will probably not materialize. But not the only ones. A few others are actually showing increased momentum as well. We think this is interesting. It's also interesting to contrast this to Europe, where we see a completely different development, i.e. our regional split between US and Europe will be maintained, and we're going to stick to having just healthcare in Europe as a stagflation trade, single stocks in Sweden, and the rest of the money in North and South America, and a small proportion to Japan and Asia Pacific. As I mentioned, Sweden, negative GDP prints as we're speaking. It is what it is, and we have to handle that from our portfolios. It's quite interesting, and I'll show you this the second to last graph. We used to trade following the same business cycle as the US. This is the OMX, Swedish OMX correlation to the Swedish and the US business cycle, just to show that we are not glued, but are obviously following the Swedish business cycle for the time being, which is a lot worse than the US. And the relationship to the US business cycle, given that US is accelerating, Sweden is decelerating, becomes even the wrong correlation sign, so we have negative correlation. This wedge is what we have right now published an interview in Hedge Nordic about the fact that we're going to have probably a blockification of the world economy, i.e. we're going to have a European bloc, a US and Asian bloc. And we can't talk about the equity market as being one anymore. We have to be prepared that we're going to have different developments, different factors of driving, etc., going forward. So the wedge here that we term blockification is so far manifesting itself. And the last slide. This might have become a little bit more than a tip of an iceberg, but not too big. Hopefully, not a Titanic kind of iceberg. But this refers to Tobin's cube, i.e. we have a massive equity sell-off. Of course, we're down in our portfolios. We're handling this with hedges, etc. But we also find it quite interesting to see that we have an equity sell-off without an earnings collapse or without a slowing macro in that stance. It's quite interesting. It's actually, if you take a Tobin's cube point of view, it's the fifth time since the 1940s that we see the equity market selling off without having a macro or an equity theorem behind it all. We can skip the whole model, but this is where we contrast today's equity market with when the same thing happened, 1962, 77, 84, and 1990. Given the fact that even if you take this historical perspective on things, we have certainly sold off in the same sort of trajectory as the previous periods, but right about now things are starting to find a trough and potentially a rebound. Now, we don't trade on this, but I think it's quite interesting to look at the events in history where we've seen this kind of breakdown in relationship between economic theorems that usually explains about 67 to 70% of equity slumps just from using Tobin's Q. If we add on Excelian spread, then we're above 90%. Excelian spread is still supportive as well. So we think this sell-off is quite interesting, and we wouldn't be surprised if it all comes down to being position-led, i.e. via margin depth, due to rates, of course. But that said, it's nothing that we sort of go all in on. We keep an eye on this, and hopefully if we get traction, that would be great. Then we can handle it as such. But before then, we're going to stick to our weights, North and South America with our big positions, unhedged in terms of currencies, hedged in terms of being short S&P 500 and long VIX. But with that, I will leave you, and I will be back in 2 weeks' time. So thank you so much, and I'll see you then.